So total risk. So, so total risk is a combination of systematic risk and unsystematic risk. So we know from the previous lecture that we can virtually eliminate unsystematic risk. Oops, there we go. So the standard deviation of returns is a measure of total risk. That's what we'll use the and what we're doing here is we're working through the development of the capital asset pricing model. So, but for a well-diversified portfolio, unsystematic risk is very small, virtually very close to zero. So, consequently, total risk for a diversified portfolio is essentially equivalent to our systematic risk. So, the we recall our efficient frontier. We had in our minimum variance portfolio here. So again, everything above here, this is our efficient frontier. Now we introduce the risk-free rate, and the risk-free rate allows us to solve for the optimal portfolio. So based on all these assets that are available in the market, we can draw a line from the risk-free rate that's tangent to the efficient frontier, and we call that, when we're talking about the capital asset pricing model and the entire market, then we call it the capital market line. Otherwise, if we're talking about combinations of securities, it's the capital allocation line. So the capital market line is basically a special case of capital allocation line. So now investors can allocate their money across treasury bills. So treasury bills are our measure for the risk-free rate, and a balanced mutual fund. So a balanced mutual fund being a combination of the best possible combination of all these assets available in the market. So the risk-free rate, is available. There's an asset available. The efficient frontier event with these identified, we can choose a capital allocation line with the steepest slope. That's the capital allocation line that creates this point of tangency. So what will happen is investors are going to choose a point between them, depending on their risk preference. They're going to choose a point between the risk-free rate and the optimal portfolio. Anything beyond this optimal portfolio would be available, but it would be using leverage. And in the capital asset pricing model, one of the big assumptions is investors have homogeneous expectations. So, in other words, this optimal portfolio is the same for all investors. It's kind of a stretch, but even so, it actually still works, and as far as a tool for market analysis. So investor chooses along the capital market line, depending on his or her risk tolerance. The main point here being that all investors have the same capital market line. This is not unlike what we see in the market today, actually, because passive investment strategies dominate the market. At this point in time, active managers have been outperformed every year since the financial crisis. So passive investment strategies have driven the market. The fact that we put our 401k money into our account, and it's invested into what effectively is a balanced fund over time. is what has created this situation. So researchers have shown that the best measure of a risk of a security, a large portfolio, is beta. So what is beta? Beta measures the responsiveness of a security to movements in the market portfolio. So the formula for beta is the covariance between the asset and the return on the market divided by the variance of the return on the market. So the way we do this is we run a regression. We're not going to run any regressions in this course, but it's quite simple. You can actually run a regression in Excel for. Basically, what we're doing with regression, we're drawing a line through all the securities and their expected returns. So the return on security I is equal to alpha plus the beta multiplied by the market risk premium, and then plus the error term. This would be the unexpected. So we would run an analysis, and it would allow us to draw a line through all these different expected returns, and we can create a security characteristic line. And the slope of that line is the beta for this security. Now, again, the formula for beta, covariance between the security and the return on the market divided by the variance for the return on the market. We can also calculate it using rho, or the correlation coefficient, multiplied by the standard deviation of the return for the security divided by the standard deviation of the return on the market. So your estimate of beta will depend on your choice of a proxy for the market portfolio. Most cases, the market portfolio, when we do this type of analysis, I would use the S&P 500. So we will start the next lecture with the capital asset pricing model.